But listen what I have said many, many times. If this is the gap here to here, extend it over, look at that little square right there. That's the midpoint. That's consequent encroachment of what? That gap that is now going to be expected to be what? An inversion fair value gap. Do we want the inversion fair value gaps to close in entirely? In other words, if it trades up to the low of it, do we want to see it trade all the way up to the top and touch that? No. Why? Because every inefficiency, if I'm short and it's trading back up into it, I want to see the upper half or some portion of the upper half of it stay open. I want to see that. Why? Because I've been talking about it since last week. Every array that is an inefficiency, if it's a gap, if it can't fill the gap entirely, and I'm short, and it trades up here and leaves a portion of it open, that is telling you the clearest, loudest way to say this market is not going up. It's weak, so start looking for lower targets. It's going to go lower. Is that a hard, complicated thing? No. Am I changing the theory around it? No. But in here, going back from here to that low, I did a lecture on baby pips. It's called Trading Inside the Range. And I started to teach the beginning elements to some of these principles. And so you go back through all of this price range, and then you have this gap here. So let's make a notation of that one. You have that. And look where the bodies are stopping in there. See that? Yeah, we go up into that fair value gap because it's there. So every new array that forms, that means any short-term high, any bearish up-close candle, which is an order block, any gap, like a fair value gap, all of them have to be referenced. My attention, every time it forms a new one in the new sell program, they're most important to me. If they agree and they converge with something inside of the buy side of the curve, which means while it was going up, if it matches, then there's going to be a lot of weight associated with that, and I expect price to remain heavy. When I'm pyramiding entries, for instance, let's just say that I wanted to sell short when we ran above these highs in here and traded right in there as a bold-faced bullish candle, selling short right there. That is a turtle soup. Why? Because it's clearing these highs, it's clearing this high, and it's trading into a premium array. And it's been going up since last week. So it's reasonable to anticipate it to do what? Retrace. And challenge what? The consequent encroachment of that wick, because it didn't do it here. So we've pushed and pushed and pushed and pushed and pushed. We had two real high impact news drivers yesterday and today. It's Wednesday. Hump day. We're in here reaching for a market level that I gave to you yesterday, and we watched it break down. I would not have been filled on any entry here at all, because I would have had a limit order right at this candle's high plus one tick. That's how I would have used it. And you watch and see me in the live stream here. I'll say I'm interested. I'm watching this to see if it wants to get up in here, because I'm not going to execute today. Not yet. I will be executing in front of you. You want to see this stuff being pushed on a button? I'm going to do that because I want my son to see how to enter orders, how to place a stop, when to move the stop. I'm going to be doing all that stuff. Turtle soup is a reversal mechanism. This is a change in the state of delivery, turtle soup. And then you have a turtle soup that is an entry mechanism that's part of an existing or unfolding sell or buy program. What does that mean? What does that mean? That means that this is a change in a directional price run that's going to most likely be sustained for a session or day or longer. The turtle soup aspect is that we're taking out the liquidity above this high and all these highs here. So the buy stops that's resting in here for anyone that wants to go short or be short, if it's not there, it's definitely above there. But how far, ICT? Well, that's the reason why you want to have these new week opening gaps and new day opening gaps on your chart. 5 weeks for new week opening gaps, 5 days for new day opening gaps. You are welcome, and I encourage you, if you can organize your chart sufficiently, to do more than that. But as a baseline to start with, you'll see many really, really nice trade setups using that criteria. 5 for end dogs, 5 days for end dogs, basically, and then 5 weeks for new week opening gaps. So if you have one element of a turtle soup that is a change in the state of delivery that causes a directional change that's going to be sustained, okay, that's a reversal pattern. Then you have turtle soups that are entry techniques that are part of an existing price run that's still yet to be completed. Meaning that we can look at all the run from here down to this low here, and anything that sees a short-term high pierced, not just by the wicks, not just by the wicks, the bodies. That's why I'm not teaching Linda Rashkin, Larry Connor's turtle soup. This right here is not that pattern either. Go look at it. I'll tell you in a very simplistic way. The book Street Smarts has a pattern. There's 2 of them. There's turtle soup and there's turtle soup plus 1. And all it is they look for a 20-day high, and if it trades above a 20-day high, they will fade that and go short. And they have a very short profit objective. To me, it's infantile. It really doesn't make any sense. But if for short-term trading, like getting in, getting out, real easy, no-brainer type things, if it's going to fail at a 20-day high or low, and I don't trade this, folks, like I don't trade that pattern. There's got to be something else. But for that book, that's all they had. And then there's 20 days plus 1, which is basically the same thing, just one more day. And reverse it. They look at an old 20-day. What's the lowest low in the last 20 days? If it goes below that, they're going to buy that. Well, that's not enough information for me. And just as well as they try to capitalize with the name, which is really clever, they try to capitalize on the low hit strike rate of the turtle traders that Richard Dennis trained, because he used that 20-day breakout system. They would buy 20-day highs, and when it was a long-term trend, it would just keep on going, and they would make their money there. But they had a lot of losing trades that the 20-day high breakout would fail, and it would go back into the range and stop them out. So they had a very, very low strike rate. If my memory serves me right, it was less than 38% accurate. So how many times are you going to stay with a trading system that has that low of a success rate? Chances are you're not. You all think you're going to get 198% and all that shit. That's not going to happen. For your first couple years, you should be tickled to death if you're less than 50% accurate and you're still profitable. That's a huge Olympic win, because most people can't even get that. You can be profitable and have a very low strike rate, but it takes the mindset of understanding that it's about making money. It's about staying solvent. It's about following rules and not blowing the account. But it's so easy to go on tilt and lose sight of what it is you're trying to do, and lose sight of these building blocks, these stepping stones to, okay, well, this is what I'm going to use, and if that one transaction fails, it's okay. I'm going to go back tomorrow, and I'm going to wait for these things to be there again, and I'm not risking a lot. So Caleb can do every execution when he starts trading, but he can't risk more than 1%. But with turtle soups that are part of an existing price run, not a change in a direction like we have here, you have turtle soup entry mechanisms for your trades. Well, can you think of one without having to go on to any detail further right at this moment? I want you to think about it for a second. What did you learn from me thus far? Maybe in this mentorship this year, maybe it's in other lectures and things I've had on the YouTube channel, or maybe I taught about it in Twitter space when I was on Twitter. What concept do you think would be one example of a turtle soup that's an entry technique in a trade that a existing trend or momentum or seller buy program is underway with? Can you think about that? What do you think it is? Institutional order for entry drill. Ooh, how about that? We have that in the form of, we have an old high here. See that? Why is this high being utilized anyway? Because it's a fair value gap. Every time I go into a short on a fair value gap, or if I go long on a fair value gap, my mind is I'm trading in an inefficiency with a mechanism of entering with a turtle soup. So I'm buying below an old low. So if I'm like, for instance, I didn't take this trade, so just for full disclosure. Let's say that I was seeing this at the time, okay, and I want to take a trade, and I want to be a buyer. I'm going to use this candlestick here, the high. Why am I using that? Remember what I was talking about earlier? Look at the wick. It's overlapping inside the top end of that candlestick. That makes that small little, I'm going to have to zoom in. I know you guys can zoom in on your YouTube, but I want to really get in here and kind of like give you the brass tacks to this. Because if I'm going to teach, I'm going to teach it right. So we have this candlestick run up, and then we have this portion where we opened and traded down. You might look at this and say, well, why don't you have this and this? That's something entirely different. This is a normal run-of-the-mill ICT fair value gap. This is what you get when you watch one video and you think you know everything about it. You don't. Just like when I teach a volume imbalance, okay? If I teach you to use a volume imbalance when there's a fair value gap in formation, that means that there's a separation between one candle body and another candle's body that is inside of the fair value gap. We don't have that here. But what do we have? We have an overlapping of this candle's high. It's all body. And then we open, we trade down. It overlaps this little portion in here. But there's no wick there. You see that? Big telltale sign. What's occurring there? It's flush and one little tap down. So, and I highlight this. I'm highlighting that. You're thinking, I guarantee you, I probably got comments right now, and they're probably going to go in there and delete it now. They use my most recent post on my community post. You're drawing the fair value gap wrong. No, you're not. You don't know what the fuck you're talking about. This is how I would classify this inefficiency. But I have to encapsulate it here because this is a balanced price range between this low and that candle's high. That is a PD array that you've never learned before. It's the first time I'm introducing it. Just like when I introduced the inception of the volume imbalance, when there's a gap, the fair value gap, you have to incorporate that because that's the real range of that inefficiency. This inefficiency here, you have to refer to that as well. Notice it doesn't even get down into that gap below right there where it was like this. There's nothing there. It's just a gap that stayed open. Yeah, wonderful. But that's not the narrative. The narrative is you have a balanced price range here inside of a fair value gap. So that's why the market goes down to that level there and sends it higher. So in case you were watching me earlier explain this, because I was in a rant, you were probably thinking, oh, this doesn't make any sense. No, you don't know all the details. This is why you can't get a 5-minute trainer. You can't get a dollar mentorship mentor telling you this stuff. They don't know. They don't know. Okay, I promise you, they don't know. And if you're not learning from me, you're getting watered down bullshit. You're not getting the real details, and it ain't gonna work for you. So extending that over here, that's the range. But if you have this candlestick here for that gap from here to here, see that? That gap is part of the sell program. It's formed as it dropped. So those are going to always be the most important ones. I'm watching that because what I'm watching is I want to see, does it converge and agree with something that's over here that formed as a basis for taking a trade. Okay, let's say that we did not have this gap again, and say we didn't have this gap and this gap. What over here would be in agreement with this 6 o'clock time? Remember yesterday at 6 p.m. we have to annotate that either with the new day opening gap if there's a distinction between the 5 p.m. closing price and the 6 p.m. opening price, because there's that 1 hour gap in price and trading. They don't trade between 5 and 6 o'clock. We always annotate that as a new day opening gap. But if the 5 p.m. closing price or settlement price is the same as the opening price at 6 p.m., all we do is draw a single line, and you can label it whatever you want. If that's all we had there, and we didn't have the inefficiency in this form of this gap here, and we didn't have that one here, what else would be there? And let's say we didn't have this wick here. Say we didn't have that. What else, if it was retracing up, what else would I lean on? I would use this, obviously, but it could trade through them. Remember, it can spike. It can cause candlesticks like it did here to have wicks. What is it doing? Look to the left. It's part of the buy side of the curve. What do you see? Don't look at my cursor. I'm not putting my cursor on it to give you any help. I want you to try to think about it and tell me what you see. Obviously, I can't see. I can't hear you. But isn't this a wick? See that? So what do you do at wicks like that? Ignore them? Oh, it's a doji, ICT. You're reinventing. Bullshit. Come on, Steve Nielsen, guys. Watch this. Steve Nielsen's the candlestick god. Puny god. Here's the halfway point of that wick. That's pretty fucking random, isn't it? It went right to that as well. And even if you didn't have all these other things, if this candlestick went up and stopped short of that, that means I absolutely know with a great deal of confidence that the next candle, when it opens, I want to trade into the body of this candle. And as soon as it does that, that's going to be treated as a bearish order block. Not because it's an up-close candle, but I'm trading it because it's inside of the range of that candlestick. Remember I was telling you many times in rants, many times on Twitter Spaces, I can trade inside of an order block before anybody else would recognize it as an order block, or they want to call it a supply or demand zone. I'm trading inside of the candlestick that will later on be obvious in hindsight to someone else. Oh, that's an order block. But you were entering before the order block. How do you know how to do that, ICT? You're getting all the answers in 2024, baby. All you got to do is show up. Just take some fucking notes. All the information is being disseminated to you. Like a fire hose, okay? Don't complain when it rips your fucking face off. Just be thankful you're getting a drink. That wick, that consequent encroachment, extended on over here. So how many things are you seeing converging right there? Lots. That tells you that this retracement here is going to send price lower. That's why I said I want to see it now go down into, go back and listen to the stream. It's going to be there. I can't change it. We're going to look at it and see if it can reach down to the lower quadrant. And it gravitates from here down to that. Then what does it do? It returns back to the midpoint, consequent encroachment of that wick. See how that works? Boom. Oh, this is classic support and resistance. No, it's not. It's not supply and demand. It's technical science. Anton Creel. It's technical science, baby. You know he's fucking watching these videos. If someone tells you that they can tell you what's going to happen in intraday charts, run away from them. They're a con man. They can't do it. They're not. Well, what do you do with us? It's a whole bunch of us doing it. Market trades out to that and then trades down to the low and explores below the low, which is what we have here. Okay. So back to this right here. For turtle soups that are part of an existing price run, anytime you're trading in a fair value gap, you're literally trading a turtle soup. You're trading above and going short an old high, which is this candle's high. So it's not support and resistance that we're trading. We're trading with the express purposes that there's an absence of buyers that's been afforded any opportunity to be a buyer above this candle's high. That's essentially what my fair value gap is doing. So let's do this. Let's amplify this. Again, this is a little reminder. If you guys are learning today, if you like this kind of stuff, because when I don't see a lot of thumbs up, and I'm teaching stuff that I never really wanted to teach, it kind of makes me feel like, you know what, I'm gonna slow my roll and I'll just not be so forthcoming with the information because it doesn't cost you anything to do a thumbs up. But the fair value gap is this. We have one single pass. The shaded area is highlighting this candle to that low, that candle, okay? I don't care about anything else except for that candle's low because there's no volume imbalance there. See that? No volume imbalance. We're part of the sell side of the curve. We're dropping. I want to see it stay low. I want to see it stay low. So I am only interested in technically seeing, I don't really have that highlighted. I'm going to take the 6 o'clock price off. So I got to remember how many steps I do so I can do Control Z. It'll put it back. Meaning this. So if I take it off, and then I'm going to add the midline on this. So that's how you do that. And I'll make it black because I want to make it pop on the chart. So all things being equal, no wick discussion. It's just this fair value gap. What we're talking about is it's part of a sell side. delivery. It's part of a sell program. The market's reaching lower for sell side or a discount inefficiency. I took your attention to the midpoint of that 830 gap, which is here. I forgot to change the color. So if it's going to trade up into this inefficiency where only one candle passed, so between this candle's high and that candle's low, it only went down one time in one candle for 1 minute. That's inefficient with buy side. Buy side is where price is offered going up. Buy side liquidity is where it's reaching for while it goes up. See? Buy side liquidity are actual pending orders in the marketplace, either to buy into a new long position or to buy and exit a short position as a stop loss being activated. I'm looking at that high right there, and I want to be a short seller generally on the fair value gap. I'm trying to put my limit order at that price or one tick above it. That's my first 6 contracts. That's my model. And then if it can trade up into the midpoint or as it starts to slide towards it, then I'll throw in my 4 contracts. So what does that give me? It gives me 4 lots. That gives me a total position so far, scaling in 10 contracts. I am not inviting you to trade with 10 contracts. I'm not saying that you have to trade with 10 contracts for it to be profitable. You should only be watching price action, Caleb, and saying, okay, this is where we're eyeballing it and saying, I want to see how it behaves once it trades there. Does it go all the way to the midpoint? Does it go all the way to the top? This is permissible. Remember that term? It's something that is allowed to happen, and it doesn't change the underlying direction or where the market's going to go. It just means that this is possible to happen. It doesn't change anything. It's better, it's much better if it only goes to half or less and then does this, because that means it's really, really weak. But because I already expect it to go lower, this is just an opportunity for the market to reprice to that level right there. That candle's low. It doesn't reduce the effectiveness of the trade. It doesn't make it more profitable or less profitable. It just gives me as a emotional and psychological comfort that I am on side. It's going to start really running away quickly after it rolls out of here and doesn't go in the upper half. So meaning this, if it's like this portion, like say it's like that much of the gap, doesn't get traded to, and say this wick only went up to like to here, but left all that shaded area open and not touched that high, and then it did this price action here, that's usually, if you watch my examples, and you'll see me talking about it in real price action when we get through the August content, and then we start looking at minute by minute, second by second candlestick, and then what you're observing, Caleb, what to anticipate, what it should do right now, not the overall grand scheme of how to reprice and where it's going to go and how to behave in those ranges. That's what we're doing right here. This is the beginning point, and it's not a one module lecture. There's a lot of, clearly, as you can see, there's a lot of things that you need to weigh out if you really want to know what price is doing, how to trust that you're going to be a part of a trade, and hold on to a trade. I've answered so many questions already in this lecture that have been brought to me over the years constantly. But I want, if I'm shorting a fair value gap, I want to enter at that old candle high. And by the very nature of it, that's a turtle soup. You're going short above that high. You're trading in an area of inefficiency, and you think this is turtle soup. You think it's this. This is dollar mentorship menu memberships where they're trying to teach you this stuff. The Wish version. Why you gotta go there, ICT? Why you gotta start some trouble? You're always trying to bring a ruckus. No, I'm trying to remind these cats that they don't know shit, and they're pretending like they do, and they're hurting people. You're messing up people's expectations and understanding, and they're actually prolonging their learning curve, because they got to learn that horse shit first and realize that they just watered down something and taught it incorrectly, and they come back to me, and then they're like, oh man, I wish I would have just started with you. Right? Whatever. You can eat where you want to eat, but you think this is turtle soup. just a high, pierce above it, and then there it is. But that is true here. That's a breaker. Breakers tend to be turtle soups in changing directional sustained price runs, where you have high, low, higher high. There's your breaker, but the essence is a turtle soup. That is not what's going on when you're using as a trade entry that's part of an existing or underlying or unfolding sell program or buy program, because you're looking at one single candle like this, and you have to get above that candle. Well, how far can it go? See, it's going to be harder for you to do these entries here, because as it's going up like that, you're not going to want to stand in front of that. It takes more experience learning the things I told you this level yesterday. And I know you probably didn't watch the video. Some of you are just looking at this one, or you didn't watch the entire video yesterday. You heard me talk about other things, and you're like, okay, he's done teaching. I'm not. Everything I said yesterday was valuable. You might not see the value in it now because you have a myopic perspective. But these levels were given to you yesterday. And the market goes up into it, trades to it, and then rejects it. It takes a whole lot more understanding and a whole lot more complementary understanding with other PD arrays to do these types of trades selling right there. And you've watched me do examples of that. It's on Twitter. Go look at it. There's examples of it on my YouTube channel too. Look in the executions, live execution playlist. You'll see it. It's there. But these are the more advanced ones. These are very, very demanding in your understanding. The fair value gap, which many of you are real accustomed to now, you're comfortable with it. What you don't realize is you're doing the same thing here. That high is here. This high is here. The difference is this is a visual aid in telling you how far this part of this run above this old high here, which is this individual candlestick. How far can it go, ICT? Where's too far? Too far is going above this candle's high. That's a stop loss. Entry here. Stop loss here. Now, that's the baseline entry strategy and where stop loss would be. Take it one step further. How can we take this to an amplified, advanced ICT mentorship video? This is a charter level content. This whole stream is a charter level. My charter students are fucking tickled to death right now. They're like, man, this is the shit. Man, we've been waiting since 2016, and here he is out there now doing it. Oh, man. They love it. You should see some of the shit they're saying. What do we have here? What is that? Let me move this out of the way so you can see. What's this part right here? Isn't that a wick? Oh. Well, let's use that information, because that candle is the high end of the fair value gap. Pattern is 3 candles. It's this one. That's candle 1. Here's candle 2 and candle 3. A fair value gap, the inefficiency, is always candle number 2. If it's a down closed candle, it's a sell side imbalance, buy side inefficiency. SIBI, SIBI. If it's a fair value gap that has an up closed candle, it is a buy side imbalance, sell side inefficiency, or a BISI, BISI. Candle number 1. If candle number 1 has a wick right here underneath it, that is a premium array. That means it's above the fair value gap, and it's trading up to here. You're thinking, I'm going to get into a trade here or at the midpoint, and you want to see the upper half of that stay open. That's this area right here. Classic fair value gap, where you start, Caleb, when you're studying this, you want to be observing price action, and you don't want to see it trade to this high right here. Okay? In other words, this is what it looks like. This is the framework, so that way you can have screenshots of it. Man, I'm so nice to you. This is stuff I did not want to teach. I did not want to teach it. You're an asshole. You should have wanted to teach this. No, it's too good. And you think you like this stuff. You ought to see the stuff that I'm never going to teach. That makes me ICT. All right, so we're going to do top right. That seems like it's probably going to be too much. Yeah, it's good. So stop loss is here, and the entry would be here. So you're going to watch this level, Caleb. This is your entry. Let me thicken it up a little bit. And we'll make that this color. Man, this is a long video. Go watch somebody else. I'm here teaching my son how to be profitable and how to read price action. You don't want to be here for that? Go do something else. So entries here, stop loss is here. That's the methodology, okay? Advanced version, okay? How do you mitigate underlying risk? How do you reduce risk? How can you use smaller stop losses? How can you make your stop loss really tight like this? How do you know that these stop losses aren't going to get hit? How do you know, ICT, when you're holding, dude, bro, the stop loss has me in tears. Oh, I'm dead. The stop loss killed me. And that's all the comments. When I'm sharing examples, when you see me using the stop loss placement, I'm going to show you one element to sometimes, not all the time, there's a lot of things that go on based on individual trades. But initially, Caleb, when you're watching price, not taking trades, you're watching it enter. You're thinking, okay, I want to see it, how it behaves here. If it goes there, I'm expecting it to go halfway, no more, but leave a portion open. But if it goes up there, then you demand immediate response where it needs to drop, okay? If it doesn't completely come back to this candle's low, and it leaves a portion of that open, that's what you want. And then you anticipate very fast speed and big, large range candles going lower. After it trades to that candle's low, like that. Once it does that, then you absolutely demand immediate response, and the same thing happens. In my videos, you'll see me say, I want to see speed and distance and large ranges going down. And then you get it. That's qualifying and quantifying the setup real time as it happens. You need to be doing those things while watching price, not entering a demo. Not entering a demo, not pushing any buttons. You do this for months. You observe and you watch, and it teaches you and trains you to see, oh yeah, this is what it looks like. It's going to behave this way. And then when you start using the elements I'm showing you here, you start with this price level plus one tick. If it can trade there, that means it's got to go 2 ticks above that. If it books that price, you hypothetically say you would be in a move, but you're not even demoing it. You're tape reading, okay? You're watching and observing. And then at that point, once it does that, hypothetically, you would be in a trade, whether demo or live, using that logic. So you do not want to see it book that candle's price high. But what happens if this is a little too rich for you? You don't like that. It's too much range. How can you reduce it? Well, if you have this candlestick number 1 in your fair value gap, if it has a wick like this is a premium array because it's going to be trading up to it. You don't want to see it trade there, but you can take that wick and do this. There's consequent encroachment of that wick, plus 2 ticks. There you go. The market will run up here. At one point, this will be a bold-faced bullish candle. You'll shit yourself, okay? You'll be scared. Some of you watch my live examples of trading, and you watch it and you're thinking, oh man, this is going to get stopped out. And then all of a sudden it doesn't. How do I know that? I'm doing things like this. but you don't want to hear me. You don't want to learn because you want a little video, something that tickles your ears and gives you right now little thing talking points so you can go around and start talking like you know something when you don't. I want you to know it. I want you to understand it. So by examples of things like this, it affords you better, efficient stop loss placement. You're not fearful. Why would I fear this never being hit? Because it's 2 ticks above the midpoint of this. This candle opens and trades down. Isn't this overlapping that candle's low when it does this? So essentially, what is this area here? It's a balanced price range. Balanced price ranges, we don't ever want to see it go down, start here, go back over, and then come all the way back to the top. If it does that, it's probably going to go higher, and I don't want to be in that trade. So I don't need to put a stop loss up there. I can be just above the consequent encroachment of that wick because it's a gap, just like this is a gap.